Should you buy or rent a home? What kind of a loan should you get? What are the factors to consider? Let's delve deep into it. This is not financial advice, but for your education and hopefully it'll help you out. So first you need to ask yourself, what are you looking for? How many bedrooms, bathrooms, maybe the age of the home? Are there good schools in the area? Is it a flood area? Do you need earthquake insurance, flood insurance? Is it a safe neighborhood? How much can you afford? What's the proximity to your work, to your family? What's the weather like? What's the cost of living like? So in order to be considered for rent or for a home, you need to have some sort of steady income. You can have 2 years worth of employment history or tax returns to help show that, or a letter from your employer if you're just starting out. You also want to make sure that your debt to income ratio is less than 50%. So take all of your debt payments, for example, credit cards, loan payments that you make every single month, and then divide it by your pre-tax income. And if you get 0.5 or lower, that's good, and you're more likely to get approved for the loan if you're buying a house. So in this case, if you had a $100 credit card payments that you had to do every single month, for example, you could apply up to $900 as a monthly mortgage payment divided by your $2,000 of pre-tax income, and you get 0.5. But if you apply for a smaller mortgage, this number would be lower, and that means your debt to income ratio would be even lower, less than 0.5, which lenders like because that means you have less debt, meaning you can afford a higher loan. This little diagram here I made helps explain what a house is. A house is an asset, and then your mortgage debt is a liability, and then the down payment that you make, and as you keep on making monthly payments and paying off the principal, your equity or the amount of the house that you own grows and grows and grows and grows until there's no more debt and it's all an asset to you and you have 100% equity in the home. Just a little sugar on top. Hopefully your home increases in value every single year, so that's automatically going to increase the property value of your home and increase the amount of equity that you have in the home. There's this helpful link here if you want to look at current interest rates. So right now for 30-year fixed rate mortgages, the average is 6.32%. You can see if we zoom in here that it kind of peaked in around October-ish, and now it's going steadily down. But as interest rates go down, the less you have to pay in interest payments, and the more likely you can afford a little bit bigger mortgage and a bigger home. And then there's this little affordability calculator here from Bank of America. If you want to just type in, like say you have $70,000 in gross household income. So this is before tax, pre-tax income. And then this is annual. Your monthly debt payments, let's pretend and just say you have $100 in payments that you have to make every month. And then I put in a zip code for Sunrise, Florida, and then I'm going to calculate it. So you can afford a house, at least according to Bank of America, for $256,497 with an interest rate of about 6.125%, which is lower than average, which is good. And then you can edit the down payment, for example. So this includes a down payment of 20%, but let's say you did half of that and it was like 10%. If you update this, you can see that you will be able to afford less of a home. And if it was $50,000, you can afford a larger home because you're putting more down. So you can kind of play around with this, but this just shows you a rough estimation of how much you can afford. And then there's this calculator that I made here so that you can compare the cost of renting versus buying. So you can make a copy, just click make a copy. And we're gonna go over the effective cost of interest, because if you buy a home, you're paying interest, while if you're renting a home, you're not paying interest. So that's the main cost I'm going to distinguish in this example. So let's say you bought a house in Fort Lauderdale, Florida for $350,000 and your interest rate is 4% and you make a down payment of 8%. So that's $28,000. So for that type of home, let's just say a similar home that you could rent with the same amount of bathrooms and bedrooms and about the same location is going to be $1,900 per month. And let's say for a comparable home, the monthly payments and interest payments is $1,166.67. Obviously, these numbers can change dramatically, so look it up and compare prices. But let's just give this example. And let's say there's an HOA fee, so a housing association fee for $20 per month. Then there's property taxes that you have to think about. There's insurance you have to think about. Renter's insurance is significantly cheaper than home insurance. And if you are in a high risk flood area or earthquake or fireplace, the insurance will be even more. But right now, I'm just saying that the property tax is 1.35%, and then the cost of the house insurance is 0.46%, and then home repairs, I'm just gonna say is 0.5% of the $350,000 value, and then renovations, I'm just gonna put 0.10%. These numbers can vary dramatically, but these are just estimations. And then for the renter's insurance, I just put down 1.32% of the $1,900 rent. So the total monthly cost is $1,925.08. And then with all of these extra things you have to do, it's going to be $1,889.58 if you buy the home. And let's say you have to put a down payment of $28,000, which was 8% of the home value, and then maybe you have a security deposit of 2 months rent, so like the first and last month's rent. So that's why I put 2 months here. There could be tax benefits, but that varies dramatically, and you have to itemize deductions. So I'm gonna ignore any tax benefits at the moment because they would depend on your state and income situation. But since you are putting down $28,000 if you buy the home versus $3,800 if you have it as a security deposit if you rent, there is an opportunity cost because you can invest this $20,000 something into a treasury bond or a high yield savings account or something that could gain interest and make it cheaper for you. And then this opportunity cost and returns will vary dramatically based on what you think you would be able to make on that investment. So I just took, if you can see, the 28K minus the 3.8K. I times it by a 4% interest rate. So you get 4% on your returns is what I'm assuming. And then you divide by 12. And then that will get you your monthly returns from not paying the down payment. And if you take your 1925.08, subtract it by your 80.67, you get an effective monthly cost of $1,844. And then if you bought instead, this would be your effective monthly cost. So on a yearly basis, it's cheaper to rent in this case. But do consider that you're not getting a home, you're just renting the place, while in this one, you're buying a home and you will have the home paid off in 30 years if you make on-time payments. I'll also put in a link below as well so that you can input different costs and determine which is better, buying or renting. But this is just one tool. Make sure you use other tools and do your own comparisons. But this is just a little like calculator here that I put down and a calculator here that I put down. That'll be in the link in the description below if you want to look at it and see which is better for you. But usually the longer that you stay at a place, the better it is to buy versus to rent. Now we're going to talk about the different types of mortgages or the different types of home loans that you can get. We're going to start off with the FHA loan, which is a government-backed mortgage loan that helps a lot of first-time home buyers and people with poor credit. So FHA stands for Federal Housing Administration. People with a credit score between 500 and 580 can get a house for a 10% down payment. So if a house costs $100,000, you can buy it for $10,000 paid down. If you have above a 580 credit score, you can get 3.5% down. So that means you can pay less for a down payment. So if you buy a $300,000 home and you pay 3.5% down, that's a $10,500 down payment. Moreover, if you have no credit history, they can look at your utility payments and rent payments and such and see how on time you are and go from there to try to get you a loan. FHA loans are only for primary residences, not for investment properties. And if you put down less than 20%, you will have to pay PMI, which is private mortgage insurance, meaning you will have an extra monthly payment that you have to make towards the insurance amount, and that never goes away. If you do buy an investment, do know that you have to pay higher property taxes, insurance, and interest most likely for buying an investment home versus a residential mortgage. But you get rental income deductions and other benefits. So do what you will. There are 5 common mortgage types. There are conventional loans, which can be used for primary homes, vacation homes, investment property, and so on. There's government insured mortgages like the FHA loan, which I just spoke about. There's adjustable rate mortgages that have low interest rates at the beginning, and then they can adjust as the economy changes. Then there's jumbo mortgages for people who want a big loan. And then there's fixed rate mortgages, which you probably want so that you know what to expect every single month and that won't change. So which loan is right for you? Well, we can talk about the conventional loan, which is just the traditional regular type of mortgage that you can get. You have to put down 3 to 20%, and you have to pay PMI or private mortgage insurance for those who put less than 20% in down payments. But after you reach 20% equity, meaning that you've paid off 20% of your principal payments on your loan, then you can get PMI removed. However, with a FHA loan, it will always stay for the life of the loan. So even once you reach 20% equity, you still have to pay PMI insurance. However, you could refinance or get a new loan, and that could, if you have at least 20% equity, get rid of your PMI. But those are extra finance charges and such. So up to you on whether or not to do it. And then you can choose to have a fixed interest rate or an adjustable interest rate. Then there are VA loans. So people who served in the US Army can qualify for VA loans where you put down 0%, and there's specific funding fees, but those can be waived. A VA loan is really good if you happen to have served in the military. So look out for those. Thank you for your service. Then there's USDA loans. So those are for rural homes or people in the countryside and such. And you can also put down 0% down payment with no PMI insurance. There is slight fees, but if you happen to want to live in the countryside and you qualify for a USDA loan, go for it if you want. Do your own research. And then if you look at credit scores, because that is important for the best rates, people with a 740 or higher will get the best rates, and that means the lowest interest rates and the less interest payments that you have to make over time. And if you make a 500, you probably want to look for the FHA loans so that you can qualify for a house loan. Now, let's talk about interest. So let's say you have a $200,000 home and it's a 30-year mortgage with a 20% down payment of $40,000. Well, if it's a 3.5% interest rate, you have to make $718.47 per month. And overall, over the life of the 30-year loan, you would pay $98,650 in interest. However, with a 1% increase in interest from 3.5 to 4.5, you will pay almost an extra $100 per month. So that's $810.70, and you would pay $131,851 over the 30-year loan in interest payments. So you can see how like a 1% difference in the interest rate made about a 12% increase in your monthly payments. So interest rates matter a lot in terms of how affordable a home is. The lower the interest rate, the higher loan you can qualify for, because your monthly payment would be less. So in high interest rate environments, which we kind of are in now, because if you can see in like 2021, 2020, the interest rates were about 2 to 3%, and then from COVID and lots of other factors, interest rates skyrocketed, and they're coming down now, but they're still relatively high, making a house less affordable. Although with higher interest rates, housing prices may have dropped because there's less demand for houses. But regardless, the higher interest rate, the less of a home mortgage you can afford. So let's prepare for buying a house. If you've decided to buy a house instead of renting, which you can use the calculators and compare on your own, but you've considered the property tax and everything, and now you're looking at actually getting a home. So let's prepare. First, you want to verify your income. So get some pay stubs ready, get some bank statements ready, and be able to explain like where the deposits came from and such. Make sure you have some steady employment, so tax returns for the past 2 years or an employer letter if you happen to be relatively new to the job. You also want to make sure you have a high credit score. It's not necessary, but you'll get a lower interest rate, remember. You also want to have a low debt to income ratio, so pay off those loans if you can before buying a home, and make sure it's under 0.5. Again, the calculator is in the description below. Then you want to call mortgage lenders. So look up your banks, look up your mortgage lenders, and just call them or see if they have a application online that you can fill out. Basically, you want to give a purchase price or range of the homes you're looking at, the credit score that you have, the down payment percentage, your debt to income ratio, and then decide on your loan term, your length. You compare these different lenders, their interest rates, and get a breakdown of the closing costs possibly, or maybe it's a percentage of the loan. And then ask maybe the appraisal or underwriting or origination cost. So I would do this all within like 14 days of each other so that you only get one hard inquiry, and you can call like 7 lenders or more and just compare. Now, there are a lot of different buyers out there, but you need a pre-qualification letter or pre-approval letter in order to be considered seriously by the seller. So you can get these from your lenders. So for example, Wells Fargo has a pre-qualification letter that you can get that's pretty fast within like the same day. You just apply online, for example, and pre-qualification letters are less stringent than pre-approval letters. Pre-qualification letters, they ask for your income information, so you just type it, and then your credit check, basic information about your bank accounts, down payment, and desired mortgage amounts, and no tax information is required. But a pre-approval letter, which is a stronger commitment by your lender to give you a loan, requires pay stubs, a credit check, bank statement, and then W-2 statements, so tax documents. Now that you have your pre-approval letter in hand, you want to find the house. So call up real estate agents, look for signs, go on Zillow.com or Realtor.com. There's lots of different sites that you can use, and your realtor that you use will also have lots of different options as well, so that you can find the house that you want. Make sure to tour it, ask questions. Some states have a property condition disclosure, so you can ask for that and see how the property is. Pro tip, even if they don't have termites, they might have a termite prevention plan. So see if you can just switch the plan over to you once you get the house. So that way you don't have to pay an origination. So that way you don't have to start a new contract and pay as much. You could pay less for the termite prevention. And then after you find the house that you are in love with and you found a good deal, then you want to make an offer. Expect the process to take at least 30 days between negotiations and getting the money from your bank and sending out all the paperwork and such. So it will take at least 30 days to close on the house. Moreover, try to get some of the closing costs paid for by the seller and ask your realtor for help. Then once you give them the offer, they might counter offer. The offer may include like furniture. You also have to put down earnest money. And then once everything is signed, you'll have to also put up some type of earnest money. It can be anywhere from like $500 to like $5,000 or more. It's the money that you put in saying, hey, I am seriously going to buy this house. If I choose to back out of this deal, you can keep the $5,000. But if I do go on with the deal and there aren't any like massive problems such as termites or the bank declines to approve the mortgage loan, then it will be applied to possibly the closing costs or to the appraisal or other costs that, as the buyer, you need to pay for. And then you've already called your lenders, but you want to call them again and ask and update them on the information that you have confirmed, such as the property address that now you are going to buy. So that way you can get the exact purchase price and down payment and compare the interest rates exactly with your credit score. And that way you can get the best lender with the lowest cost, with the lowest interest rates to pay for the house that you are about to buy. Moreover, you need to get home inspections, appraisals, and other miscellaneous things to make sure that the house is proper and in order. Make sure to read the home inspector report. Make sure everything electrical wiring, water problems are non-existent. Just make sure you go through everything and make sure that it's all no problems, or at least very minor problems. And then if it is a problem, you can ask the seller to fix the problems, so that way you don't have to fix them. Then make sure to send all the paperwork to the lender that you chose. So that'll be bank statements, tax returns, income verification, a lot of different paperwork. It will take at least 30 days, as I mentioned before. Then after everything's complete, you're gonna wire the money and use some type of title company and change the utility accounts and all of that, fun moving things to do. This is an example of a home loan disclosure that your lender is going to provide you. So if you chose a loan term of 15 years, the purpose was to buy a house and it was a fixed rate mortgage that was conventional, then you have your loan ID, then there's a rate lock. Currently the interest rate is 3.125% on this home loan disclosure, and the rate is locked until July 2nd, 2020. So they usually lock it for about 30 to 60 to 90 days, meaning that the interest rate won't change even if the economy changes and the interest rates increase, because your rate is locked. This is for a loan of $90,000, and the monthly and interest payments are $626.95, and this amount cannot increase after closing. And there's no prepayment penalty or balloon payments. Then you can see the principal and interest payments, the estimated escrow. So this will be property tax, insurance, and whatever other amount they put in escrow. Basically, you're paying part of this as your monthly payment, so the bank knows that they have enough to make sure you pay the property taxes, you pay the insurance, and make sure that you take care of the home. So this is $808. And then, as you can see, the estimated taxes, insurance, and assessments are the $181 that I mentioned before. And then the closing cost, including loan costs and other costs, lender credits and such, is $5,553. So the estimated cash to close, like if you were to close the deal right now, you need this much money to be wired to the mortgage company in order to buy the house. And then this is a further breakdown on origination costs, the processing fees, appraisal fees, credit scores, title fees, recording fees, homeowners insurance, mortgage insurance, prepaid interest, property tax. And then if you scroll down, you can see the initial escrow payments at closing. And then maybe there's lender credits, for example, making the loan cheaper. But overall, after everything's said and done, you will owe $70,553 to close on the house and make it yours. And then there's some other information that will be on the disclosure, such as home insurance premiums or estimations, and then title insurance premiums and estimations. And then you want to move in. So after you move in, also check the day beforehand, before the deal closes, to make sure everything's in order, and then sign the paperwork. But make sure your door is locked, that you do any address changes that you need to. So go to the post office, make sure you get your mail forwarded to your new address, and then go to your DMV, update your car tag, your registration, your car license. And if you happen to get any mail from the previous owners, just write down "no longer at this address" and return it to the sender. Do apply for homestead exemptions that will lower your property tax. So if you live in the home as a buyer instead of a renter, like the owner, then you can have an exemption from some of the property tax to make it lower. And if you're married, there's another exemption. And if you're a senior, like 65 plus, there's another exemption. Or if you're in the military, there's another exemption. So just make sure you apply for all the exemptions that lower your property tax. And then you'll receive your real warranty deed in the mail after a month or more that shows that you own the house after the mortgage is paid off. So make sure that you consider all the variables. There is a lot of variables, but I had a lot of calculators and research I've already shown you so that you can decide on whether to buy a home or rent, but do your own research as well. If you are staying in a location for maybe 2 years or more, it might make more sense to buy a home. There's more stability in buying a home, but there's more flexibility and you can move anytime you want if you just rent. You have to consider how much rent will increase every year and also how much your house will appreciate. Maybe think of buying a duplex where you live in one unit and then the other unit you could possibly rent out. Also know that home ownership is expensive. There's insurance, there's property tax, there's maintenance. A lot of those things you won't have to worry about if you just rent the home. Another thing you want to look at is, are you eligible for first-time homeowner grants? So there's free money out there that can lower the closing costs, that can lower the down payment that you have to pay. So Bank of America, for example, has the America's Home Grant Program, which offers a lender credit of up to $7,500 that can be used towards non-recurring closing costs, such as title insurance, recording fees, and to buy down the interest rate so you pay less interest. And the funds do not require repayment, so it's free money. There's also our down payment grant program, offers a grant of up to 3% of the home purchase price, up to $10,000. So you could save $10,000 from the down payment with these grants. So just make sure you look into them, ask the lenders that you're applying for loans for if they have any grants and if you qualify, so that you can get free money. So takeaways: be patient, shop around for different mortgage lenders, get the best interest rates and the lowest cost. Also shop around for the house that you want. Make sure that, well, it's a very big decision, so make sure you do your research. And then see if it makes sense to rent or buy. And long term, buying is usually cheaper and better, but if you're only going to stay somewhere for a short while, then you can rent it out. Moreover, once you buy a property, you could Airbnb it or rent it out so that you can make some extra income. If you have an extra room, maybe rent that out. Just a thought. So home ownership is a very big decision, but hopefully this helped you understand the differences between renting and buying and how to buy a home, picking out a FHA loan or a conventional loan, and just understanding what it takes to buy a home. Thank you for watching. This is Bailey Zong, That Money Guy. Have a wonderful day.